It's Brian Preston, the money guy.
The average savings rate in America is only, and I use the word only, 8.5% right now.
And by the way, that's up. You know, that's because pandemic right now, the money, it's actually increased because we've been locked down and so forth. It's typically around 7%. So we are failing miserably at saving a portion of our income, and that's not good. And but look at our stat that we have here on personal savings rates. You can see that the pandemic caused all kind of distortions, but traditionally, it's just right above 6 or 7%. There is a little distortion. This is how nerdy we are. When we see charts, we go, why in the world did it go up in 2013? Tax rates were going to go up, so there's a lot of income accelerated. But overall, it's easy to see the takeaway. 6 to 7% is the average or median savings rate. And guys, that's not good enough. That's not the guidance we give if you're going to build financial independence. But let them know what is the numbers of what we think is success.
Well, traditionally, you used to hear, way back when, they say, hey, if you can save 10% of your gross income, you're probably going to be in a pretty good spot. Well, when that 10% of gross income number was thrown out, pensions were still a thing. There were still companies that would pay you a guaranteed sum of money for your entire retirement, and you were going to have Social Security that was for sure going to be there back then. Now the game has changed a little bit. The onus for saving for retirement now rests on us, the individual participants. So saving 10%, we don't think anymore will get the job done. We think if you want to be saving what you're supposed to be saving, building for true financial independence where you can do what you want, when you want, the way that you want, your goal should be to be saving 20 to 25% of your gross monthly income.
So we actually did, being numbers nerds once again, we decided, hey, if you are saving 25% or by age, what should you be saving? We have some research that we've been able to compile.
So here's the case study we said. We said, okay, if we just assume a 6% annual rate of return, very, very conservative, and we assume that your wages increase at about 1.5% a year, so roughly half of what a normal inflation rate is, and we assume that you want to retire at age 65, replacing 80% of your pre-retirement income, how much would you have to save? And this is what we found. For a 20-year-old, if you can start at 20, you only have to save about 12% of your gross income to replace 80% of your pre-retirement income. Now, if you do what the Money Guy Show says and you save 25%, by the time you get to 65, you can actually get a pay raise in retirement. You can live off of 167% of what your pre-retirement wages were.
Or maybe you even get to retire a little sooner than 65. There's nothing wrong with getting a little ahead of the game. But I think a lot of folks don't start at 20, Bo. They probably start after they graduate college around 25. What does that do to the numbers?
Yeah, at 25, if you want to have that same level of retirement, instead of only having to save 12%, now you got to save 15% of your gross income in order to replace 80% of your pre-retirement income. But again, if you can figure out early on how to be a financial mutant that saves 25%, when you get to retirement, when you get to age 65, again, you can have a pay raise. You can actually replace 131% of your pre-retirement income, or just like you said, you could retire a little bit earlier.
So we've seen 20-year-olds 12%, 25, 15. Where in the world's 25 coming to 20 to 25? We can see it has to do with 30 and 35-year-olds.
Yep, absolutely. So if you wait until 30, that's when 20% no longer becomes the goal. I'd argue it pretty much becomes a necessity. If you want to replace 80% of your pre-retirement income, then you need to save 20% of your gross income starting at age 30. If you wait until 35 to start doing this, then you have to be saving 26%. Only to replace 80%. So the earlier you figure this out, the earlier you can recognize you need to be a financial mutant, the more comfortable for a retirement you're going to set yourself up for, and the earlier you'll be able to achieve financial independence.